friends. The topic for today's lesson is financial performance. Before going into topic, let's check your knowledge for previous lessons. Here is the situation I want you to solve by accounting technique. One day I needed to buy a ticket that should cost no more than $50. I borrowed $35 from one friend and other $15 from other one. With borrowed money I paid $45 for the ticket and walked back to my friends. On my way, I met with a neighbor who asked me for $3 for urgent need. I lent her the requested $3 and went to meet with my friends. I gave $2 to them, $1 for each of them, thus I owed $34 for one and $14 for other. In the evening I took $48 from my mother and went to visit my friends. On that way I met with my neighbor who paid back the borrowed $3. Strange, in my hands I have $48 to pay back my friends and additional $3. I started with $50 and ended with $51. After paying my friends I got $3. How can this be? How can you explain the surplus of my financial transactions, if any? Did I create an additional economic value? Hint. You need to write all entries for each transaction. Let's back to our topic, financial performance. In our definitions for asset and liabilities, you may notice the statement of economic benefits. For assets we say that we expect the inflow of economic benefits. For liabilities we say that we expect the outflow of economic benefits. In other words, we expect some changes that creates additional economic value, inflow, or creates destructive economic value, outflow. However, we noticed that when purchasing some asset we get increase of economic benefit by increase of the value of asset. When we paid back the loan we decrease the economic benefits by decreasing the value of asset. At the same time we couldn't see either the increase or the decrease of the net worth of our household. Why is that? Because the change of asset was directly correlated with the change of liability or inversely correlated with the change of other asset. Simply saying, when asset goes up, the liability goes up too. We call it direct correlation. The resulted increase of total asset value. Or, when one asset goes up another asset goes down. We call it inverse correlation. As the result, the total asset stays the same. Same when asset goes down, the liability goes down. Direct correlation, the result decreases total assets. When one asset goes down other asset goes up. Inverse correlation. Total asset stays the same. Similarly with liability. When it goes up asset goes up. Total liabilities, thus total liabilities and equity goes up. When it goes down asset goes down. Total liability thus total liabilities and equity goes down. Direct correlation. When one liability goes up, other liability goes down. When liability goes down, other liability goes up. Inverse correlation. The change of one liability with other is called refinancing. BRRR. Enough with that I have got a tongue twist from this definitions. Just remember that shuffling with the weights on economic scale doesn't create economic value. The reality is you can directly manage your asset weight on your balance scale, you can directly manage your liabilities, but you can't manage directly your net worth. It is the result of something else, your economic activity, your economic performance, your financial performance. Income and expenses. There are two types of financial performances. One is called income. Other is expense. As you may guessed, income is the inflow of economic benefit and expense is the outflow of said economic benefit. So, the result of income and expenses, in other words inflow and outflow of economic benefits, will show current value of net worth of your household. We shall call it net contribution. We are going to define income as an additional economic benefits that inflows into your household in exchange for providing goods or services or through investing capital. For household, the source for our income is payroll, salary and wages or any other active income sources that requires our direct involvement in the process of income generation. There is another type of income that doesn't need our direct involvement and thus called the passive income. We shall talk about active and passive types of incomes in more details later in my lessons. The core meaning of family economics is in consumption of economic benefits for the needs of the family. Basic needs, psychological needs, self-fulfillment needs. We shall call the consumption, outflow, of economic benefits, the expenses. Income for our household is the money we receive from employer as an employee working with a company. At the same time, employee as human needs to eat, rest, and other life-required arrangements that he or she is going to spend, consume, and use the own asset, money, which is called expenses. Let's take some paper divided in fancy way. Folded. Put here the word income. And here, put expenses. Now making life easier, let's find out how much money you received in last month and put it in the space for income, name by name with numbers. Then, take all your expenses name by name and put them in expenses space with the numbers. Done. Good. Let's make some groups. You can use different color markers. Okay. We start from income side. Take, say, orange marker and circle the money that you are receiving periodically. They may be salaries, periodic checks for services. Salary, W-2. $3,600. Use blue to circle the money that you received for occasion services. Say you may use Uber driving occasionally, not as your permanent job. Uber, 1099 miscellaneous. $200. Use red to circle the money that you received as borrowed from somebody or when somebody paid your money back. This is not an income, we shall keep them for balance sheet transactions. Borrowed from neighbor. $50. Good. Now, let's go to expenses, the most interesting part. First, orange, group is basic needs. Circle the expenses that you make that are needed for life. We shall learn more of it in budgeting lesson. Anyway, you may put food, shelter, rent, mortgage, cloths. Here you can include utilities, electricity, gas, water, telecommunication, phone, internet, transportation, vehicle lease, car insurance, etc. It is up to you to determine what are your need expenses. Food. $700. House rent. $1,200. Cloths. $200. Utilities. $300. Telecommunication. $300. Take a blue marker to circle expenses that you make, but you could survive without them. Say, entertainment stuff. Nobody blames you. It is your money. Relax. Cinema. $50. Take a yellow marker to circle the payments you make for protection and investments. Life insurance, health insurance, IRA. Life insurance. $200. IRA. $300. At the end, take red marker to circle the payments for your loans and borrowings, except interest payments, and the money that you lent to your friends and expect to take the sum back. These are not expenses. We need them for balance sheet transactions. Payback for credit card. $300. So, let's sum up incomes and expenses to find total income and total expenses for the period, 1 month. Total income is $3,600 plus $200 equals $3,800. Total expenses is $700 plus $1,200 plus $200 plus $300 plus $300 plus $50 equals $2,750. As you may noticed, I didn't take life insurance and IRA into expense calculation. We shall talk about the specifics of life insurance and investments in next lessons. Then find the difference between income and expenses to get your additional or subtractive economic value, that for our household, we shall call net contribution to our net worth, equity. Net contribution is $3,800 minus $2,750, that equals $1,050. Let's build the report. We shall put income on the top, then we reserve the place for total income. Then beneath we reserve the place for expenses and have the place for total expenses. Below we shall place the resume of calculation, net contribution. Actually, what we did, we build the income statement for our household. The profit and loss statement for the companies look similarly. Now we put the numbers. Here are the parts for income. Salary, W-2. $3,600. Uber, 1099 MISC. $200. Total income is $3,800. Now, let's fill in the expenses. Food, $700. House rent, $1,200. Cloths, $200. Utilities, $300. Telecommunication, $300. Cinema, $50. Total expenses equals $2,750. Net contribution is $1,050. Let's do some fun with accounting now. You know from previous lesson about double entry method of recording and bookkeeping, accounting. To remember the debit or credit position of income or expense, first imagine the income statement report where income comes first like on upside and expense comes next, like on downside. Income, expenses. Now rotate the report clockwise for 90 degrees. You'll see them like expenses are on the left side and income is on the right side. As you have learned, we call the left side as debit account and the right side as credit account. So, expenses are debit accounts when income is credit account. As you remember, I know, you do. The value of account increases when we debit the debit account or credit the credit account. When we debit the credit account or credit the debit account, the value of that account decreases. What else? Very important to remember that even if expenses are associated with the income, they are not depend on it. It is clear especially for household. Whether you earn money or not, you need to eat, right? That is why income and expenses are not tween accounts, or in correct terms are not correspondent accounts. We record income transactions separately from expense transactions. In our case, I used cash account as correspondent account for both income and expenses. Let's draw a table to record transactions for income. Transaction 1. Received salary for the month. Cash is debit account, I receive money, which means my cash value should go up, then I need to debit my cash account. On the line cash I put $3,600 in debit column. The correspondent account income is credit account, I got the income means my income value goes up, then I need to credit my income account. I put $3,600 for income from salary in credit column. Total debit equals total credits, $3,600. Done. Transaction 2. Received money from Uber. Same logic, I put $200 in debit column for cash and $200 in credit column for income from Uber. Total debit equals total credits, $200. Done. Now let's make entries for expense transactions. Table 2. I made expenses. That is why my expense account should go up. Expense account is the debit account. Thus, I need to debit it. It means, I write the name of expense accounts here and put the dollar amounts in debit column. Food. $700. House rent. $1,200. Cloths. $200. Utilities. $300. Telecommunication. $300. Cinema. $50. I paid for the expenses from my cash account. It means the value of cash account goes down. Cash account is the debit account, thus I need to credit my cash account. I write cash account here and put the numbers in credit column. Total debits equals total credits, $2,750. We have balance. Done. The connection of financial positions with financial performances. This is the topic for next lesson. Today we had. Net worth is the result of financial performance. Income is the inflow of the economic benefit when expense is the outflow of it. Difference of income and expense is called net contribution to net worth, or net contribution for short. You create an income when you exchange your goods or services with the economic benefits that can be measured by money. You issue the expense when you consume the economic benefit of your household for the need of household that can be measured by money. Income account is credit account. Expense account is debit account. We used made-up numbers to learn how to record financial performance transactions. That's it for now. Thank you for watching. P.S. Did you solve the problem with $50? Well, here are the steps how to solve the problem using double entry technique. Table 3. Transaction 1. I borrowed $50 from my friends. Debit cash for $50. Up. Credit debt to friend 1 for $35. Up. Credit debt to friend 2 for $15. Up. Total debits equals $50. Total credits equal $50. Checked. Transaction 2. I bought the ticket for $45. Debit ticket $45. Up. Credit cash $45. Down. Total debits equals $45. Total credits equals $45. Checked. Transaction 3. I gave $3 to neighbor. Debit lending to neighbor $3. Up. Credit cash $3. Down. Total debits equals $3. Total credits equals $3. Checked. Transaction 4. I gave back $2 to my friends. Debit debt to friend 1 $1. Down. Debit debt to friend 2 $1. Down. Credit cash $2. Down. Total debits equals $2. Total credits equals $2. Checked. Transaction 5. I borrowed $48 from my mother. Debit cash $48. Up. Credit debt to mother $48. Up. Total debits equals $48. Total credits equals $48. Checked. Transaction 6. I received $3 from my neighbor. Debit cash $3. Up. Credit lending to neighbor $3. Down. Total debits equals $3. Total credits equals $3. Checked. As a result of 6 transaction, we see following distribution of financial positions. Table 4. As we see, I have not only $51 cash in my hand, but also ticket that worth $45. In total, the value of my asset for that moment equals $96. That is exact number I owe to my mother $48 and my friends $34 and $14. Total assets $96 equals total liabilities and net worth $96. The event when I borrowed $50 is past and doesn't play role anymore in current situation with current positions. Moreover, going forward in paying $48 to my friends I get following positions. Table 5 Transaction 7. I paid back $48 to my friends. Debit debt to friend 1 $34. Down. Debit debt to friend 2 $14. Down. Credit cash $48. Down. Total debits equals $48. Total credits equals $48. Checked. Table 6. In reality, I had ticket that worth $45 and $3 cash that was paid me back from my neighbor. It is the exact number of $48 that I borrowed from my mother. Balance. Giving back $3 to my mother. I will have situation if my mother gave me exact number of money to buy a ticket, $45. I hope you enjoyed it. See you next time. Thank you for watching.